Here's the long-form narration for Black Monday 1987, a day that rocked Wall Street. On October 19, 1987, the U.S. stock market experienced a dramatic downturn known as Black Monday. This day saw the Dow Jones Industrial Average drop by more than 20%, or approximately 508 points in today's terms, marking one of the largest single-day percentage declines in history. While the immediate causes were complex and multifaceted, including issues such as overvalued stock prices, economic policy uncertainties, and technological changes that sped up trading, this event highlighted the vulnerabilities inherent in financial markets. It prompted significant regulatory changes and a reevaluation of risk management practices by investors and institutions alike. Imagine it's October 19, 1987. You wake up and turn on the TV to see the markets are already in turmoil. The day that would go down in history as Black Monday has just begun. Today, we're diving into what happened during the infamous Black Monday crash of 1987, how it affected millions of people's lives, and why understanding its lessons is crucial for investors today. On October 19, 1987, the Dow Jones Industrial Average fell nearly 23% in a single day, marking the largest one-day percentage decline in its history. That's a loss of over 508 points. To put it in perspective, if that same proportional drop occurred today, it would equate to losing about 6,700 points overnight. So what caused this massive panic? The story starts months before Black Monday when markets were booming. The Dow had hit record highs and was up more than 50% from August 1986 to early October 1987. But all that growth led to overconfidence and speculation. In the years leading up to 1987, many investors poured money into the stock market, sometimes without fully grasping the associated risks. Margin trading, which involves borrowing money from brokers to purchase additional shares, became increasingly popular. This practice contributed to a significant rise in stock prices that was not entirely justified by underlying economic fundamentals, setting the stage for a potential bubble. Then came October 1987, when concerns over high interest rates and slowing economic growth led investors to increasingly sell off their holdings. By mid-October, fear in the market was rapidly escalating. On Black Monday, October 19, 1987, financial markets around the world experienced significant declines. The London Stock Exchange saw its index drop by about 10% before the New York market's opening, setting a negative tone for global trading. When the U.S. stock market opened, it too faced rapid and severe declines throughout the day. Panic selling began early in the morning. Within an hour, the Dow Jones Industrial Average had fallen over 2%, with more than $500 billion in today's dollars in market value lost that day alone as the situation worsened throughout the trading session. As the day progressed, the volume of sell orders overwhelmed broker systems, exacerbating the decline. By lunchtime on October 19, 1987, many stock exchanges around the world experienced such heavy selling pressure that some had to halt trading temporarily to stabilize the markets. The day saw unprecedented volatility and panic, with investors witnessing significant declines in their portfolios in real time. One of the most significant factors behind the 1987 stock market crash was program trading, which involves computerized strategies that automatically execute large trades based on predetermined conditions. As prices declined, these programs triggered widespread sell-offs, exacerbating the price drop and creating a self-reinforcing cycle of panic selling. The result? By the end of the day, the Dow Jones Industrial Average had fallen by 508 points. Globally, this translated to a loss of approximately $1 trillion in market value. The crash didn't just hit Wall Street, it reverberated around the world, with markets from Japan to England experiencing similar dramatic drops. But here's a crucial lesson. After Black Monday, markets rebounded surprisingly quickly. By the end of November 1989, the Dow Jones Industrial Average had already surpassed its pre-crash levels. Despite the panic and losses, long-term investors who held steady weathered the storm without permanent damage to their portfolios. Subject: Black Monday 1987, a day that rocked Wall Street. So why is this history important? because it teaches us about market psychology and how fear can drive prices far below their intrinsic value. The crash of October 19, 1987, demonstrates that even healthy markets can experience sudden severe drops when widespread panic leads to mass selling. Now, let's look closer at how margin trading fueled the 1987 stock market crash. Margin accounts allow you to borrow money from your broker to buy more stocks than you could afford with cash alone. This practice amplifies gains during bull markets, but also magnifies losses during downturns. When Black Monday hit in 1987, many investors had borrowed heavily through margin accounts to fund their stock positions. As stock prices fell, brokers called for those loans to be repaid immediately. Many investors couldn't pay back the loans, forcing them to sell more stocks at lower prices just to cover their debts. This cycle of forced selling exacerbated the market decline. Another factor was how leveraged financial institutions were using derivatives, which are complex contracts tied to market indices and other underlying assets. When markets crashed, losses in these derivative positions exacerbated selling pressure, intensifying the volatility of an already unstable situation. But why did so much money vanish overnight? It's not just about the actual stocks losing value, it's also about the psychological impact. On Black Monday in 1987, investors panicked because they feared further losses and wanted to cut their exposure immediately, regardless of whether it was a good idea or not. This panic selling exacerbated the decline in stock prices. This mass sell-off drove prices down faster than any underlying economic fundamentals could justify. In short, fear created its own reality that day, causing massive market disruptions despite a lack of clear reasons for the crash. Now let's look at how this played out in real people's lives. Many individuals who had invested their hard-earned savings witnessed significant devaluations within hours. For retirees living off dividends and interest income, those sources were severely impacted as companies cut back or went under. It was a devastating event. But here's the kicker. Despite all the chaos and fear, long-term investors fared much better than short-term traders who tried to time the market. Those who maintained well-diversified portfolios eventually recovered their losses and continued growing their wealth over the subsequent years. This story teaches us a critical lesson about patience versus panic. During events like Black Monday in 1987, when the Dow Jones Industrial Average fell by more than 20% in a single day, panic selling can lead to significant losses that may take years to recover from. Meanwhile, maintaining discipline and sticking to long-term investment plans often pays off even after major market downturns. Subject: Black Monday 1987, a day that rocked Wall Street. So how can investors understand the impact of events like Black Monday? First, diversification is key. Don't put all your eggs in one basket. Spreading investments across different asset classes helps mitigate risk during market swings. Second, rebalancing regularly helps keep your portfolio in line with your investment strategy and reduces exposure to any single asset class or security. This practice prevents excessive concentration and helps manage risk over the long term. Third, it's crucial to understand the risks involved in margin trading and leveraged investments. While these strategies can offer the potential for higher returns, they also significantly increase volatility and the risk of substantial losses. It's important to stick to investment strategies that you fully comprehend and are comfortable with. Staying informed about economic trends and market conditions is crucial. Maintaining a balanced perspective grounded in reliable information helps prevent impulsive decisions during volatile periods. In the wake of Black Monday in 1987, regulators implemented new measures like circuit breakers, which are mechanisms designed to pause trading when an index falls by a predetermined percentage within a single day, to prevent similar episodes of extreme market volatility. But despite these measures, understanding past crises remains crucial for navigating future ones. History teaches us that while market downturns are inevitable, how we respond to them can make all the difference in preserving our financial well-being. So remember, stay patient, diversify your investments, and focus on long-term goals rather than short-term gains. This approach has withstood historical tests and can help shield you from future market volatility. And that's why Black Monday 1987 isn't just a historical event. It serves as a timeless reminder of the importance of sound investment principles in today's markets. This is educational and historical, not financial advice. Black Monday in 1987 taught us the importance of liquidity during times of crisis. Many investors who couldn't sell their stocks quickly enough found themselves locked into losing positions for extended periods. Having cash reserves or highly liquid assets like short-term treasury bills can provide a buffer when markets freeze. Another critical lesson is to avoid panic selling. On Black Monday in 1987, many people rushed to sell their stocks, locking in significant losses that could have been avoided by staying calm and sticking to your investment plan. Remember, market downturns can be opportunities for long-term investors to buy quality assets at potentially lower prices. The crash also highlighted how interconnected global markets can be. In U.S., stocks fell sharply after international markets showed weakness earlier in the week, underscoring the importance of monitoring economic conditions globally rather than focusing solely on local indicators. Behavioral finance indeed plays a significant role. During periods of market volatility like Black Monday in 1987, investors often make emotional decisions instead of relying. In Chinese letter, 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 Chinese. Behavioral finance also significantly influences investor behavior. During market volatility such as the 1987 Black Monday crash, investors often act emotionally rather than making rational decisions based on solid data and long-term goals. Mastering emotional management is crucial for successful investing. Subject: Black Monday 1987, a day that rocked Wall Street. Passage to fact check. Finally, Black Monday demonstrated the impact of government intervention in markets. After the crash, the Federal Reserve took swift action to stabilize credit markets. This quick response helped mitigate further economic damage. Understanding these actions can provide insight into how policymakers might respond during future crises. Subject: Black Monday 1987, a day that rocked Wall Street. So as we look back at Black Monday on October 19, 1987, let's remember it was a defining moment in financial history that taught us invaluable lessons about resilience and the importance of maintaining long-term investment strategies through volatile market conditions. Stay informed, stay calm, and keep your long-term goals in focus regardless of market fluctuations. This is educational and historical, not financial advice. Black Monday highlighted the role of computerized trading systems in exacerbating market volatility. These automated programs, designed to execute trades based on preset parameters like stop-loss orders, contributed significantly to the rapid decline in stock prices that day. When one major institution initiated large-scale selling due to these algorithms, it triggered a chain reaction across the market. Another critical lesson from Black Monday, which occurred on October 19, 1987, was the importance of diversification. Investors who had spread their investments across various sectors and asset classes were better insulated against catastrophic losses, compared to those heavily concentrated in individual stocks or sectors that plummeted sharply overnight. Diversification is not just about spreading risk, but also about hedging bets on a wide range of economic scenarios, thereby improving the resilience of investment portfolios. Furthermore, Black Monday underscored the value of regular portfolio rebalancing. By regularly adjusting your investments back to your target allocation, you can prevent extreme concentration in any single asset or sector. This practice helps maintain your investment strategy and mitigate significant overexposure to market volatility. In conclusion, while Black Monday on October 19, 1987 was a terrifying day for investors, it provided crucial lessons that still hold true today. Understanding the risks associated with market volatility, embracing diversification of investments, and regularly rebalancing your portfolio can help build a more resilient financial future. Stay informed about market dynamics to better prepare for any economic challenges that may arise. This is educational and historical, not financial advice.